Good afternoon. My name is Ricardo Naranjo, and we're Group 6. We're going to be introducing you guys case study number 3, financing SNS air expansion, plans with a bond issue, and this is my teammates.
My name's Jose Ibarra.
I'm Jasmine Melendez.
I'm Stephanie Espinosa.
And I am Nicolette Ristau. In this slide, I will be going over the agenda for this presentation. So first, we will be going over the introduction and summary of the case. Then we'll be talking about what is a security bond, what is the seniority bond, the presence of a sinking fund, a call provision, dates and call prices, a deferred call, a company, what is a make-whole call, what is for the positive covenants, negative covenants, what is a conversion feature, and what is a floating rate and coupon. Next slide, please.
I'll be sharing some information about our case and the company. So the company that's going to be regarding our case is it's going to be SNS Air, and the owners are going to be Mark and Todd. Their goal is that they want to expand their operations. They hired a financial analyst named Chris, who has a responsibility to underwrite to help and sell 35 million in a new 10-year bonds to finance construction. He wants to connect with another financial analyst to get more information about the bonds and consider what are the coupon rate issues that they would have. As the team Group 6, we will be the assistant and we will be giving him more information.
So I will be going over the security of the bonds, basically if the bond has collateral. So to begin with, bonds with collateral, that basically means that it's a secured bond. And that generally also means that they have a lower coupon rate compared to bonds that are unsecured. That is because the collateral reduces risk for investors. So it's basically like a low risk, low investment, low in return. So a few advantages of this are going to be that investors have a claim on the collateral in case of default, which reduces their risk and justifies the lower coupon rate. And a lot of investors might be interested in investing because it is secured, which is, like I said, a lot lower risk, and that attracts a lot more conservative investors. A few disadvantages will include restriction on assets. So the company will not be able to sell certain assets just because, you know, it could damage their effects. So making any changes is really not the best idea, especially since they're not so flexible anymore, since it's secured. And also maintenance costs. The companies must keep the collateral in good condition, which may incur additional costs. So yeah, that's a huge disadvantage.
So now we're looking at the seniority of the bond. So its effect on coupon rates. So senior bonds, which are prioritized over other debts in case of liquidation, generally have lower coupon rates than subordinated or junior bonds. This is because senior bonds are considered to be less risky. Some advantages would be higher priority in liquidation. So senior bonds are paid before subordinated bondholders in the event of bankruptcy, which then reduces their risk. This priority increases the attractiveness of senior bonds to investors as it provides a higher likelihood of repayment. The second advantage would be potentially lower interest costs. So due to the reduced risk, the interest costs or the coupon rate for senior bonds is what makes it lower. This can result in lower overall financial costs for the issuing company. So moving on to disadvantages, limitation on future issuance. So issuing senior bonds may restrict the company from issuing additional senior debt in the future, which could limit any financial or financing options. This limitation can constrain the company and its ability to raise any other additional funds through senior debt if needed. The second risk would be perceived risk of subordination. So if a company frequently issues senior debt, it may signal financial instability. This increases the perceived risk of its subordinated debt. This can also lead to a higher coupon rate for future subordinated debt issues as investors demand a risk premium.
Okay, now moving over to the presence of a sinking fund. The sinking fund would reduce the coupon rate because it's a partial guarantee to a bond holder in case of any economic failure. Like I said, if a sinking fund is managed by a bond trustee for repaying its bonds, and at an early stage, an advantage would be it reduces the refinancing risk and it lowers the coupon rate. Disadvantage would be that the firm must generate a cash flow to make payments to the sinking funds. Moving over to the call provision with specified call dates and prices. The provision is with specified dates and prices will increase its coupon rate, but it must protest its paying high rates for a long period of time, even if the rates drop. Also, the company can refinance at a lower interest rate. With these rates, when these rates fall like significantly enough to offset the call provision cost, an advantage would be that there's flexibility for the issuer and it's lower. It has a lower initial coupon rate. Disadvantage would be having a high uncertainty and a risk. And the risk for the investor, which demands a higher coupon rate.
For this slide, we'll be going over a deferred call accompanying the call provision. So a deferred call is another form of call provision where the issuer agrees not to redeem the bonds within a specific period. This feature introduces a period of stability for investors, assured that the bonds are not called. The coupon rate for this deferred call is slightly lower than the standard bond. So for some advantages for the issuer would be that it ensures funds for the present value of remaining payments, risking potential loss for early redemption. A deferred call provision issuers can make their bonds offering attractive to investors who value guaranteed period of interest payments. So a disadvantage would be a smaller coupon rate because of interest protection. The issuer loses flexibility to call the bonds during a deferred period, which can be a disadvantage if interest rate drops. For the investor, some advantages would be provides flexibility to call bonds if needed while saving on interest costs, interest rates as interest rate declines. A disadvantage that it may be expensive if premium must be paid to call bonds. There is a chance the bonds will be called after the deferment period, which brings reinvestment risk. Next slide, please. Next slide, please. Thank you. So a make-whole call provision makes the bond feature that allows the issuer to redeem the bond's maturity, but requires the issuer to compensate bondholders with a premium equal that presents remaining interest payments. So a whole call provision is typically lower than in the impact that the coupon rate. The provision assures the investors that they will receive a premium that estimates the bond's value. Advantages would be the issuer gains flexibility to get the bond early in the market conditions if conditions are favorable when interest rate falls. So allowing them to refinance and lowering their cost. So another disadvantage for the issuer will be premium costs for the investors are high, making redemption financially unattractable. So an advantage for the investor would be the provision attracts investors who are likely added security, lowering overall and borrowing cost. Investors are compensated fairly for the loss of future interest payments if the bond is redeemed early, which reduces reinvestment risk. A disadvantage, though, would be lowering coupon rates because make-whole conversion offers security for investors, which these bonds are typically lower compared to without these provisions. Next slide.
So now we're looking at any positive covenants. Also discuss several possible positive covenants SNS Air might consider. So first and foremost, some of the effects on coupon rate. So positive covenants usually assure investors that the company will take specific actions to maintain financial health. This reduces the perceived risk, which lowers the coupon rate. Looking at advantages, as I mentioned, the lower coupon rate. Also the investor's confidence in the investment itself. Moving on to disadvantages, operational constraints, having to stop doing other things in order to compensate for these covenants, and increased administrative burden, meaning more paperwork and more administrative work in general. Looking at specific examples that SNS Air might consider would be minimum working capital, regular financial reporting, and maintenance of collateral. When looking at minimum working capital, it would likely be phrased SNS Air must maintain a minimum working capital of, let's say, 5 million throughout the term of the whole bond to ensure liquidity and operational continuity. And for regular financial reporting, it would be worded SNS Air must provide quarterly and annually audited financial statements to bondholders to maintain any transparency and again help assure the investors' confidence. And third, maintenance of collateral. So SNS Air must maintain all collateral assets, such as any new facilities, or in this case, any aircrafts, in good working condition to ensure they remain valuable and secure.
So I'll be going over any negative covenants and also discuss several possible negative covenants SNS Air might consider. So to begin with, negative covenants are basically like rules that are meant to like lower risk for the investors by restricting or limiting what the issuer can do. This will protect investors, but it can also be a downside for the issuer. Specifically for SNS Air, these negative covenants would limit their flexibility and ability to make like certain business decisions, directly affecting how they operate and manage their finances. So there's no flexibility for them, in other words. So a few advantages of negative covenants would be that the investors have reduced risk, specifically for this investment. That is because they are limited on certain actions or changes on what they would like to do or can do. So the issuer might gain the skill of managing their finances better since there's less room basically for them to like mess around with or make any risky investment behavior and lose a lot of money or go bankrupt. So that prevents that. A disadvantage would be the issuer may have a good investment opportunity, whether it could be like a merger or just an investment. They aren't able to do so because of the restrictions and limitations the negative covenant has. For the investors, on the other hand, they will have lower returns. So limitations, so positive, negative covenants SNS might consider would be limitations on incurring additional debt, which as mentioned is basically excessive loans or investments, restrictions on mergers and acquisition, and basically limits on what assets that they can sell, because that can lower their company value and stuff like that, so.
So I'll be discussing about the conversion feature. So it is options to bondholders to exchange their bonds for a number of shares of issuing the company's common stock. It is commonly found in the convertible bonds or preferred stocks. Some advantages is the potential for capital gains, which bondholders can benefit from potential increases in the issue stock price if the convert of their bonds into equity. Another one will be flexibility for investors. It will provide investors with the option to convert with their fixed income and secure into their equity. It allows them to be part of the company's growth and potential dividends. Another advantage will be the appeal to investors. So the appeal to investors, the company's issued securities may attract to Borders range of investors looking for both income and potential capital. This advantage will be the potential reduction, and it would also be the potential for profit for bonders holders. Next slide, please. I'll also be discussing about the floating rate coupon. So a floating rate coupon changes based on the benchmark interest rate, which can go up and down. It is also referred as floater or FRN. An advantage is if interest rates decrease, the company can incur a lower interest payment, offers protection against rising interest rate, which can be appealing to investors when rates are on the rise. A disadvantage is introduces both issuers and investors regarding future interest payments. With a floating rate coupon, if interest rates increase, the company may pay a higher interest rate.
Thank you.
And now, thank you.